What are the different types of universal life insurance and what exactly makes them different from each other? Welcome, this is episode 6 of our Secrets to a Tax-Free Growth series. Now that we've kind of gotten into some of the details of how universal life can be used for living benefits and kind of explained away some of our concerns, we can start to get back into the details. So let's do exactly that and get straight into it. There are 3 types of universal life. There's fixed, there's variable, and there's indexed. Now, if you've taken a look at my channel or been referred to this series from one of my other videos, you probably know by now I primarily work with indexed universal life. I tend to believe it is the best option amongst the 3, especially in today's environment, and I want to break that down very deeply. However, before we can take apart indexed universal life, kind of how it came to be in 1997 and how they were able to use floors and caps to protect against market downturns while still getting the market-like returns, first, we need to look at fixed and variable life. We'll tackle indexed universal life a bit more in depth in our next video, but let's start here. First is fixed. Like it sounds, it's a fixed rate. Similar to what we've described before, you put money in, a portion of that goes towards your fees, a portion of that goes towards your cost of insurance, the rest of the money is your cash value. That same cash value is able to grow tax-free, you're able to access it tax-free, it transfers tax-free. You do still have protection from the market downturns in this case. What they're doing is they're crediting you a fixed rate. You get that new rate and then it's going to compound and it'll keep compounding and compounding, crediting you a rate each year, allowing for compound growth. In order to understand how they actually get that rate, first we need to understand a company's general account portfolio. So whether it is fixed, variable, indexed, they're all going to have this general account portfolio account where they're getting a certain percentage. Now, we've talked about how insurance companies a lot of times will keep some of their money in AA or AAA bonds. Maybe sometimes they'll keep it on some mortgages, whatever it might be. But based on all these places that they're putting in, the average return they're getting, they're able to credit you a certain amount. So let's say they're averaging 6, they might pay you 5, they have their 1% for their overhead, and they're the ones taking the risk, so they want to take some profit. Similar to how banks work. Let's say you're putting money in a bank, they're going to pay you 1% on that money. You might ask, how are they actually able to pay me 1% of what I already have in there? And the reason is, what they're doing is they're borrowing your money, even though like you think it's just in an account and locked away in a safe. That's actually not what it's doing. You're giving them your money. What they're doing is taking your money and they're going to loan it out somewhere else, say at 5%. So they go and make 5% somewhere else, they loan it to someone else at 5. Well, now let's just say you have $100,000 in there. They're gaining 5% on that, so 5,000, and they're paying you 1,000. So what they're doing is they're making a spread on money you've given them. Same thing applies with the insurance companies. You give them money, they're able in their general account portfolio, for example, to earn 6, they might pay you 5. Opposed to a bank, they might earn 5 and pay you 1. So as a little summary to this idea, let's just say you had $1 million in cash value, the general account portfolio is paying 5%. At the end of that year, they would pay you $50,000. Otherwise, 5% of that million, now you have $1,050,000 that then would be credited the GAP rate or the general account portfolio rate for the next year, and it would continue to do that over and over again. Now, the general account portfolio rate can change and fluctuate based on kind of the rate of returns that they're getting across all of their bonds and mortgages or whatever it might be, their portfolio, but that is how they determine their rate, and that is how they determine what they're able to pay you if you had a fixed universal life. Next and second is what is variable universal life. Now, very simply, first, what you're doing is you're just keeping enough money in there to cover whatever fees or cost of insurance there is, and the rest of the money you're telling the insurance company, hey, so keep that money in there to cover the cost, take the rest of it and put that in the market. That's why, since it's in the market, if you're actually selling variable universal life, you'd need a securities license. Since you're actually selling a security, just like if you were selling mutual funds, you would need that as well. So you can imagine the pros and cons of a variable universal life are going to be much more similar to something like a mutual fund, where if the market does really well, you can get a much higher return. The con, of course, being if the market did very poorly, you could lose a lot of that money that you had in there. And especially if your policy, for example, isn't fully funded and the market did have a bad year, it could really get into the disaster of the agent calling you and saying, hey, you need to put in more money just to even cover the cost of insurance because the market's been down. Now, that's not going to happen every time the market goes down, especially if it's funded or properly structured, but it is something to note. Now, generally when people are coming to me or looking at indexed universal life in general, yes, they love the tax-free growth, they love the tax-free access, they love the tax-free transfer, they love the market-like returns, but the main thing that they're looking to do is get out of the market. They've seen enough volatility, they want peace of mind, they don't want to deal with the ups and downs. And that's not to say VUL or mutual funds are a bad or terrible idea. I personally have my own Roth IRA. I just personally like most of my money in a place where it's liquid, especially in a place where it's safe, not only as an institution, but from market downturns. And that is exactly what Indexed Universal Life can provide. Let's take a deep dive into that in our next episode. It's episode 7. I will see you there.